Hey, good morning, guys. What is up? It's Caeli Ridge here, Ridge Lending Group. How is everybody this morning? I am going to begin this video by stalling. Hi, good morning. All right, what are we talking about today? We are going to be talking about credit today. And I have to hurry because the playoffs are on and I'm already delayed. I got to get home so I don't miss the action. Okay, credit. So what I'm going to be speaking about today is we're going to be talking about credit minimums, the minimum credit score requirements to qualify for conventional financing. I'm also going to share with you tricks about optimizing your credit scores for the purpose of avoiding, ultimately, having to pay higher interest rates or less desirable terms, which in reality, let's face it, that could equate to tens of thousands, literally, of dollars spent on interest, right? Otherwise, nobody wants to do that. So let's get right into it. Credit score qualifications. So I always like to kind of start these things with definitions, again, as they apply to the underwriting guidelines. And we're really going to focus most of these videos on conventional financing terms. So definition, credit score requirements. First of all, I'll start by sharing that most individuals will come to us with 3 different credit scores. These credit scores come from places that I call, or that the lending side of the world calls, repositories. You guys are going to know them more commonly as Equifax, TransUnion, and Experian, right? Those are probably familiar names. For the purpose of qualifying for conventional financing, we are going to take the middle of those 3 credit scores to qualify you. In the event that there are 2 borrowers, say a borrower and a co-borrower, we're going to take both of the middle, and then we'll use the lesser or the lower of the 2 middle scores, FYI. Okay, the other thing I want to quickly point out for those of you that may not know, when we talk conventional, Fannie Mae, Freddie Mac, everybody knows those names, there are 10 conventional loan spots per qualified individual. Now, of those 10, there are unique underwriting books, we will call them, that we have to adhere to when talking about the underwriting qualifications. In this case, for credit purposes, the first book is applicable to the spots 1 through 6, and then there's a second book or set of guidelines that we have to subscribe to that will be valid for the loans that fall in the 7th, 8th, 9th, and 10th loan spot. Okay, so let's focus on 1 through 6. So minimum credit score requirement in 1 through 6. It's kind of vague, really. There's no hard and fast rule, to be honest. In fact, just recently, I saw an approval for an individual that had a 618 middle credit score, which in fairness is on the lower side, but the individual had compensating factors. These are going to be things like low debt to income ratio or strong assets. So really in 1 through 6, credit score requirement isn't as tangible, and it's not as important as the other factors that I just mentioned, debt to income ratio and assets. 7 through 10. They raised the qualification bar on us here, okay? There now is a hard and fast. You must maintain a minimum middle credit score of 720 or greater to qualify. No exceptions. A lot of times our clients will come to us with very high credit scores. I'm going to give you kind of one of the tricks of optimization, or a few tricks of optimization. But let me give you a quick story first, or some background. So let's say Mr. Smith comes to us and he starts, and he's a clean slate. He doesn't have any rental properties yet. He comes to us and he's got an 800 middle credit score. More often than not, you're just going to assume that credit is probably not going to be a topic of discussion that we're going to have with him as it relates to his qualifying, okay? With one exception, and it would be a temporary exception. Let me explain. So this applies to something we call rapid acquisition, okay? When an individual might be out there aggressively acquiring rental property, in a small window of time, the credit score can be impacted, and can be impacted significantly. Example, so let's say that we're closing out in that 1 through 6, because in that case, again, zero chances that an 800 credit score, 750 credit score, even a 700 credit score is going to have any need to discuss what that looks like in 1 through 6. But let's say that this individual is rounding out that 1 through 6, maybe he's already purchased 4 or 5, and we know that he or she has ambitions to purchase another 3 or 4 in the next 4 to 6 months, okay? What would probably happen there is that rapid acquisition of mortgage debt, and let's clarify, this is not a car or credit card, this is a big ticket item. What's happening in that case is that the algorithms within those repositories that I mentioned earlier see all of this massive debt being loaded to the individual's social security number or credit profile. And in that example, it would very likely take a very high credit score, even an 800 credit score, and drop it down below that 720 mark, okay? Until, more often than not, we have at least a 30 to 60 day post window of time from the last acquisition, right? Let's say the last acquisition ended or finished conclusion on January 31st. 30 to 60 days post that date is typically when we will start to see those credit scores rebound back to where they started, if not even higher. Because what's happening here is that those ones and zeros that I'm talking about, the algorithm, all they're seeing is this debt, but they're not seeing the time is not allotted to show the on-time mortgage payments, right? Which is a pretty big deal. With that, that's where we start to see the credit scores rebound. Now, one of the tricks of optimization that we know to impose or to apply is that the credit score itself is valid for 120 days per guideline before we have to run or have a new one, okay? So knowing that, if our clients are communicating with us appropriately and we kind of have a trajectory of what those goals are going to look like, chances are good that perhaps on day 78 of 120, depending on where we are in its life cycle, I may suggest or insist that we run a new credit report, a brand new credit report before all of that other mortgage debt starts hitting that individual's profile. So what have I done there? I've actually bought us a new 120 days at the same high credit score level before all the mortgage debt starts hitting, and that just buys us time, right? There's a good optimization trick. There's some other optimization that I'm not going to get into right now. However, if you want to click right here, or maybe it's right here, here, I don't know. But click there if you want to see the video that has to do with reading a credit report. A lot of people get their online free credit reports, etc. But those aren't going to be the same as what you're going to find in a mortgage-related credit report. It's called a tri-merge. Reading a trade line, what the abbreviations, all of that stuff looks like. And within that as well, there'll be some optimization tricks for how to keep your credit at its optimal levels and keep that credit score at its highest. Okay, so that's really credit. I hope that was useful to you guys. What I would love, if you would like to, or if it suits you, leave a comment. Let me know what your experiences are. Share with the rest of us what your experiences have been with credit, how you've optimized, maybe some of the mistakes that you've made, that you've had to overcome. Credit's a pretty big deal when we're talking about real estate investing, and whether you can qualify or not, or how to optimize interest rates and terms, etc. All right, next up, what is next? Next is going to be our asset conversation. That's a really good one, actually, because I'm going to be able to share with you guys some visual aids and the matrix from conventional financing, what you need to understand and be prepared for to satisfy what sort of assets you can have, how they're used, etc. Click here, I don't know, click somewhere on the screen, you'll see it pop up to watch that one. I look forward to seeing you guys again. This is not, my team isn't playing today, so I'll leave that out. I won't even say who I'm not rooting for. Hope you guys are having a great Sunday, and we'll see you soon. Thanks.